Welcome to Sustainability Soundbites, presented by E&E Leader. Are you aware we offer custom sponsorships for editorial categories? Send us a message to learn more, or check out Amazon's current sponsorships with us. Corporate PPAs can start looking like debt to analysts. Rating agencies are already looking beyond reported debt to capture long-term contractual obligations. And S&P Global Ratings has explicitly identified corporate PPAs as commitments that could enter adjusted debt once their payments become material, fixed, and difficult to avoid. Corporate power purchase agreements, PPAs, have traditionally been evaluated as procurement tools built to lock in electricity economics, support renewable development, reduce exposure to volatile power markets, and advance corporate clean energy targets. For finance teams, that framing may no longer capture everything a long-term contract commits the company to. As companies accumulate long-term obligations for electricity, data centers, leases, equipment, and other infrastructure, credit analysis increasingly looks past what appears on the reported balance sheet. S&P Global Ratings' 2026 credit analysis of hyperscaler contractual commitments makes clear that an obligation can factor into adjusted debt calculations once it becomes material, fixed, and difficult to escape. That does not mean every corporate PPA is debt in practice. Most are not. But CFOs and boards approving large portfolios of long-dated energy contracts need a second leverage calculation beyond how accounting standards classify the agreement, one that reflects how a credit analyst would size up its claim on future cash. A fixed payment PPA reads differently than a variable one. The distinction matters because the accounting and credit questions are different. A company can sign a 15 or 20-year power agreement without borrowing money to build or own the underlying generation asset, and depending on the structure, the resulting obligation may never appear on the balance sheet the way a bond, loan, or finance lease would. Credit analysis can still look past that presentation. Under S&P's methodology, variable power purchase agreements generally are not treated as debt-like obligations when payments depend primarily on usage or production. Those agreements are typically treated as executory contracts, with expenses recognized as electricity is consumed. The treatment can change once the underlying economics do. S&P's framework allows a contractual commitment to enter adjusted debt when it is material and creates a fixed, debt-like future call on cash. And in those circumstances, the agency calculates the present value of unavoidable minimum payments using an imputed cost of debt and adds that figure to adjusted debt. The question that matters is not whether a contract is labeled a PPA, but how much financial flexibility it removes once conditions change. Boards rarely see the numbers. Finance needs. That distinction becomes more important as corporate energy portfolios expand. A board reviewing a proposed PPA typically sees electricity pricing, contract duration, expected savings, renewable energy attributes, and the project's contribution toward corporate energy targets. Finance should be looking at a different set of numbers: minimum contractual payments, fixed capacity charges, termination liabilities, guarantees, and take-or-pay provisions, separate from whatever developer counterparty risk the agreement carries on its own. Those provisions determine how much of the company's future cash flow has effectively already been committed. A single PPA may have little effect on a company's overall credit profile. The issue becomes more consequential once companies stack multiple long-term agreements while taking on leases, construction commitments, equipment purchases, and conventional debt. At that point, reported debt alone gives an incomplete picture of flexibility, and a portfolio that looked manageable, contract by contract, can look different once every obligation is added together. Rating agencies are already looking past the balance sheet. That shift is already visible in the technology sector. Microsoft, Meta, Oracle, Amazon, and Alphabet have committed roughly $1.9 trillion in future payments under leases that have not yet begun, mostly for data centers powering the AI build-out, nearly 4 times the lease liabilities already recognized on their balance sheets. Microsoft carries the largest disclosed pipeline at $329.1 billion against $88.5 billion recognized, and Meta had disclosed $279 billion before signing another $68 billion of data center leases in July, pushing the 5 companies' known pipeline to roughly $1.16 trillion. Those figures describe data center lease commitments, not renewable power purchase agreements, and should not be read as PPA balances. But the reasoning behind them is what CFOs evaluating energy contracts need to understand. An obligation does not have to appear on the balance sheet to shape how a credit analyst reads the company's capital structure. S&P Global Ratings has already acted on that reasoning for at least one hyperscaler, incorporating Oracle's $260 billion of uncommenced leases into its adjusted debt forecast. S&P separately estimates the top 5 hyperscalers will spend roughly $750 billion on capital expenditures in 2026, about 38% of combined revenue, underscoring how much of that build-out runs through instruments outside conventional debt reporting. Rating agencies apply similar logic to leases broadly, treating them as debt-like financing, because fixed payments over long periods can reduce financial flexibility, much the way borrowed money would. PPAs are different instruments, but the underlying credit question is the same: how much cash the company is contractually required to spend regardless of future operating conditions. Utility PPAs set the precedent for this kind of scrutiny. There is a longer-standing precedent in the utility sector for treating purchased power as close to debt. Moody's has long considered purchased power agreements when assessing utility credit because those contracts can function as an alternative to owning generating assets outright, and under its most conservative treatment, certain PPA obligations can count as debt because capacity payments may effectively finance the generation asset supplying the utility. Corporate renewable PPAs are not the same as utility capacity contracts, and that methodology should not be applied directly to commercial and industrial buyers. The precedent still matters, because credit analysis has long recognized that transferring ownership of an asset does not eliminate the economic characteristics of financing when the buyer remains responsible for long-term fixed payments supporting that asset. For corporate energy buyers, contract structure matters as much as contract size, and 2 PPAs of identical dollar value can carry very different credit implications depending on how their payment obligations are written. Energy procurement is turning into a capital structure decision. That reality changes how companies should evaluate the next agreement. Energy procurement teams tend to optimize for electricity prices, renewable supply, contract tenor, market exposure, and sustainability objectives, while treasury teams evaluate leverage, liquidity, borrowing capacity, and credit ratings. Large long-term energy commitments increasingly sit between those two functions, and the contract terms buried in the fine print rarely make it from one desk to the other before signature. Before approving another agreement, finance teams can model it under a more conservative scenario, one that assumes the unavoidable portion of the commitment were capitalized and included in adjusted debt. That exercise does not predict how a rating agency will ultimately treat the agreement, but it shows whether leverage changes materially under stricter treatment. The test matters most for companies pursuing capital-intensive expansion, since a business simultaneously signing power agreements, leasing facilities, constructing data centers, buying equipment, and raising conventional debt can accumulate fixed obligations without seeing them all in the same leverage metric. Sequencing matters too, including how a company accounts for delivery shortfall risk on contracted volumes not yet priced into its models. An agreement that looks manageable alone can look different once another acquisition or borrowing program joins it. What off-balance sheet treatment doesn't tell you, none of this makes PPAs inherently undesirable. Long-term agreements can hedge electricity exposure, provide price certainty, support development of new generation, and let companies secure energy without putting generation assets directly on their books. The financial risk comes from assuming that accounting presentation ends the analysis, when for a credit analyst it is often just the starting point. For CFOs and boards, the better question is how much flexibility remains once every material fixed commitment is considered together, not just what an accountant classifies as debt. A PPA does not become debt simply because it runs 20 years. But once its payments are fixed, material, and hard to escape, finance teams should understand what the contract looks like through a credit analyst's eyes before the board signs it, because that is the reading that will matter if conditions turn. Thank you for listening.